group statements where the equity of the subsidiary includes preference share capital. Please refer to Introduction to Consolidations, Chapter 8. Before we start with the new work of Chapter 8, let's do a quick recap. Chapter 1 to 4 is now assumed knowledge. It forms the basis of the consolidation process, and going forward we will just build on that process and follow exactly the same work method. Example 4.1 is particularly important because we spend a lot of detailed time on that example, going through the given information, understanding the consolidation journal entries, understanding the NCI journals very specifically, and then identifying how those consolidation journal entries ended up changing the line items in the consolidated financial statements. Going forward, we will just be adding more consolidation journal entries, but the consolidation process remains the same, and you will just have to keep on being able to see how those journal entries changes the line items in the consolidated financial statements. NCI is particularly important, and you will pick up on that as we move through Chapter 8 theory. So it's important that you really now understand how we measure NCI, how we calculate those amounts, and then the journal entries that we write to achieve the change in the NCI balance. Remember, NCI's balance will change proportionately as the equity of the subsidiary changes. They are equity participants. We measure them with reference to their proportionate share of the equity of the subsidiary. Yes, I know at acquisition date, for the ordinary share NCI, we do have the option to measure them at fair value. But since acquisition date, we attribute a proportionate share of the change in the equity of the subsidiary to NCI. So very distinctly, we had two steps when we measured NCI. Under step 1, we attributed a portion of the equity of S that they are entitled to in their balance. We said this is what NCI is measured at, this is what they're worth. We increased their balance with the positive movements in the equity of S. Then, as a second step, we adjusted their balance for the actual dividend declared by S, which came through in Chapter 4. We used an analysis of equity or a timeline to help us to calculate these amounts so that we follow a structured approach when we have to measure NCI. Then another important principle that's been coming throughout is that single economic entity principle. We achieve that by combining 100% B and 100% S line by line in the consolidated financial statements. But then we didn't leave it at that. We changed the relevant line items with the effect of the consolidation journal entries. In Chapter 8, you will now see there's just more consolidation journal entries to account for. So to ground your understanding of measuring non-controlling interests and analyzing the equity of the subsidiaries so that we can attribute it to the equity participants of S, let's just recap this timeline. Remember, at acquisition date, the at acquisition equity of the subsidiary eliminates. It's not allowed to be in the group. It was earned before the group was formed. It's a common item with the investment by the parent. It's not allowed in the group. For NCI, we measured NCI, and I've now added something here. In all the previous chapters, we only had a situation where the subsidiary had issued ordinary shares. So what we were doing was measuring NCI in that ordinary shares issued by the subsidiary together with their equity share in the other equity items of the subsidiary. So at acquisition date, NCI in the ordinary shares were measured either at fair value or at their proportionate share, and there was a journal entry to achieve that. Then we said we have to identify the since acquisition date movement in equity and attribute that to the parent and NCI. For the portion that we've attributed to NCI, there was a journal entry, a credit to NCI, increasing their balance with this increase in equity of S, and the debit was retained earnings of S, where we've moved that amount from so that we can attribute that to NCI. In the current year, we did the same for profit for the year that we've attributed to the parent and NCI. And again, there was a journal entry to achieve that change in the balance of NCI. Debit profit attributable to NCI, credit NCI. But then in Chapter 4, we've introduced the intragroup dividend declared by the subsidiary. As the dividend was a negative movement in the equity of S, I had a negative movement in the NCI since balance. There was also a journal entry that achieved that. Please remember this concept. We've done this. We will keep on doing this. And as I continue with the discussion of Chapter 8, you will see where the new Chapter 8 preference shares fits into this scenario.